MTN SME Hub. Link to growth, link to success, link to the ultimate resource for business advice and insights.
Welcome back to the Big Small Business Show. In studio with us, we've got George Diab. He's the founder and CEO of Gas Accounting, and we've been talking today all things taxes, and we're going to continue our conversation about something, well, I hope you don't ever experience, but if you do, you'd want to know about it, and that is assessed losses. What are assessed losses, and how does it affect us from a paying tax perspective?
Assessed losses is bittersweet. So the bitter part is really
that you lost money.
That you lost money. At some point you made a loss, and none of us really get into business to make a loss.
Yeah.
But at the same breath, SaaS recognizes this. And so what SaaS does is allows you to carry over that loss into the next tax period where potentially you might have made a profit.
Yeah.
And we can use that loss from a previous tax period, offset that against our current profit, and pay less tax.
100% of it?
No.
Okay.
No. So it used to be,
yes.
But then the guys, they got clever. And I suppose at the end of the day, it's SaaS is there to collect money, and in order to keep the economy going, they have to get cash flow into the system.
How long can I use that assessed loss?
The assessed loss carries forward as long as you're creating taxable income. You touched on it now. So the assessed loss is, however, limited to 80% of your taxable income. So you can't ever utilize your full assessed loss.
Yeah.
Or you can, provided your taxable income is higher than your assessed loss. But at some point, you're always going to be paying tax, at least 20%. Of your taxable income you'll be paying in tax.
So tell me how that calculation, so let's just go to the maths of that.
Yeah.
I lose 100 Rand.
Yeah.
And then the following year make 50 Rand.
Yeah.
Okay. I take 50 Rand from the assessed loss.
Yeah.
And I take it off the 50 Rand of my profit. And so I'm deemed to make zero profit, so I pay zero tax.
No.
Okay. So
it used to be like that.
All right. Now what happens?
In 2023, it changed. And now you have a 100 Rand loss.
Yeah.
And you've got a 50 Rand profit this tax year.
Yes.
Now, SaaS is saying you can only utilize 80% of your taxable income, your assessed loss to 80% of your taxable income. So the 50 Rand, now 80% of that is 40 Rand.
Yeah.
So you can only utilize 40 Rand of your assessed loss.
Yes.
So you're going to be paying tax on 10 Rand.
Yes.
And the balance, the 60 Rand, carries over into the next tax year.
Okay, so you don't lose the 100 Rand. You just effectively can only use up to 80% of your actual taxable income. Okay, I got that right now.
So it carries over into the next tax year.
And it carries on, okay, until that 100 Rand is all depleted.
Fully utilized.
Okay.
Exactly.
And even if there's part of that, so if you've got theoretically, there's 10 Rand left in that I haven't used for my assessed loss, and I make 50 Rand, okay, I can bring that 10 Rand across.
Exactly. Then you can utilize the full assessed loss because it's obviously there's no limitation that applies, and it reduces your taxable income.
Is there a situation where SARS would say, if you keep making assessed losses?
Yeah.
And I know we're moving into another realm of Companies Act, but if you keep making losses year after year after year after year, and you never make a profit, is there a limit to how many years you can make a loss before SARS says you're trading recklessly or there's a problem here?
To be honest, I haven't seen that, but what I have seen SaaS often do is they ring fence losses. So potentially you've got two parts to your business. The one is a profit-making part, and the one is a very big loss-making part. And SaaS will then come and say, no, you can't keep making losses over here and let the profitable part support this loss-making division. We're going to ring fence the losses on this side, and we're going to tax you on the profit that you make over here. So you're not going to lose your assessed loss, provided it is a genuine assessed loss. You've got the tax deductible expenditure to claim against it. But you're not going to lose that, but they're going to ring fence it and say, this business or division needs to now start making profits so that you can then utilize your assessed loss, but we're going to tax this. We often see it in individuals, Allon, where I'm earning taxable income or remuneration, I'm paying PAYE, but I've got this investment property that is loss-making.
Yes.
And I want to utilize this loss-making investment property and claim back some of the tax I've paid. And SARS says, okay, I'll let it go for a couple of years, but eventually they're going to come and they're going to ring fence that investment property and say, cool, we're not allowing you to claim those tax deductions against the taxes you've paid via PAYE. But eventually, when your investment property makes money, you can utilize your assessed loss there.
Buying an assessed loss. So I want to buy a company. It's got an assessed loss. It's completely usable. Its tax loss is completely usable even if I buy it from somebody else.
Yeah, so long as you're trading in that entity, you can utilize that assessed loss. But what sometimes happens, and people get confused about it, the entity has to be trading in order for that assessed loss to apply. If at any point that entity was dormant,
yes,
you lose your assessed loss.
Okay, and dormant means what? What
didn't trade during the year, didn't make any sales
during the year.
During a year.
During a year. So theoretically, if you traded 100 Rand during the year, it's not dormant.
It wouldn't be dormant, so long as there's some trading activity happening.
Okay. So, to have, I'm just coming to the ring fencing story about into two property, as you gave that example. Maybe I shouldn't say this on TV, but are there clever ways to reduce your tax by if you in your business to ensure that you do use your assessed loss better? Are there efficiencies in thinking about this better?
So I think the tax legislation kind of applies. There's a lot of deductions and allowances that SARS gives you, tax credits that you can utilize. It's just really around working with the right tax practitioner that understands all these benefits or potential deductions that you can claim and utilizing them to the full potential. And also kind of knowing like the tricks of the trade that, if you've got an assessed loss, just make sure that company continues to trade, even at a minimal level, so that at some point you can start utilizing those assessed losses. So I would say there's tips and tricks, but the legislation is really clear, so it's quite black and white.
Okay, George, we're going to have to cut it there. All right, so you heard it there from George Diab. He's the CEO of Gas Accounting. Stay tuned.
MTN SME Hub, link to business success.